Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. This show gets you actionable insight on everything mutual fund related, and that is particularly useful on a day like today, where you're seeing sharp cracks across the board in the equity markets. Joining me to talk about two very important subjects, I have Jigar Patel, who's the Principal Officer at Neuron Wealth Advisors, and Mrin Agarwal, who's financial educator and in fact the founder of FinSafe India. Thank you so much to the both of you for joining in. Incidentally, I chose the topic for today not knowing that there would be sharp selling across the board, but despite what we're seeing on the screen, it's still a great time to take stock. I decided to talk about the health of your mutual fund portfolio, and most retail investors have their portfolios in mutual funds. And I asked each of you to come up with 5 ways or 5 checkpoints that you can use to ensure the health of the portfolio. I will come to you first, Mrin, on what you've selected, and we'll go point-wise to talk about each of them. You first talked about performance relative to the benchmark and category average, and you've also talked about tracking error for passive. Why is this the first point to bear in mind?
Since we're looking at an existing portfolio, I would say that, of course, it's important to track performance. And again, I think, the 5 points that I have given are in conjunction. It's not like one can only track performance and nothing else to ensure good health of the portfolio. But certainly, yes, performance is a very big parameter that needs to be tracked by individuals to ensure that their portfolios are actually outperforming benchmarks and the category averages, just so that they're able to meet their financial goals finally.
I'll come to you next, Jigar. You've talked about goal tracking, and I would assume whether or not your portfolio is geared towards meeting the goal. So adjusting the selection of funds to match the goals that you've set, I'm guessing in terms of duration. Is this what you meant?
Yeah, usually what I believe is money or wealth that we have, it is not an end, but it is a means to an end. So when you invest in a mutual funds, you always have a goal in mind. It may be, of course, duration is one part of it, but you always need to track how closer you are to that achieving that goal. If you are closer to it, or if you're very short of it, you can think about whether this mutual fund is a good fit in my portfolio. So I think that's the reason I have goal tracking as the number one reasons to check the health of the portfolio.
You've both talked about asset allocation as the second point. I'll come to you first, Mrin. On a day like today, it's particularly important to talk about this because you have a sharp and sudden crack. And this is something that we've been warning our viewers about consistently over the past several weeks, that perhaps in certain pockets of the equity market, you have a bit of a stretched valuation situation happening. Is this a great opportunity to look at asset allocation and to review?
As far as reviewing of portfolios is concerned, typically I recommend that people do it once in a year. And stick at that, because every time there is a market movement, I don't think that it's going to be feasible for people to look at their asset allocation, and it also might lead to some knee-jerk reactions as well. But yes, asset allocation is really important just to check whether you are invested in line with your risk profile. And I think a lot of portfolios have seen this, where you started with 30% equity allocation and that's maybe gone up to 40-50%. And I think one of the things to really check is that the sort of allocation that you want to maintain, and if it's gone up, what do you want to do about it? So I think really, as Jigar also mentioned, that the basis of any portfolio is to really meet financial goals. And it's very important that we don't get driven away by market movements and look at, and all of this stems from the risks that you're willing to take. So really looking at whether what I have allocated is going to help me achieve my goals. And if it is really overstepped in some form, then what are the various actions that need to be taken to come back? Because all the studies do show us that 94% of the performance of our portfolio is actually driven by asset allocation, and only 6% is driven by the actual security selection.
That's a fair point. But having said that, there is also, there is a way to measure this. Of course, you look at your portfolio and you see that if there is a significant deviation from the asset allocation that you've selected, Jigar, then you should correct it. Even if equity has gone from 70% to 75 or 80%, would you say that a 5 percentage point deviation is appropriate to look at, or should you wait till it gets worse than that?
When you say 5%, it is actually 10% because it can go to -5 to +5, right? So it's always going to be, you have to take a judge. I think 5% is a good barometer. If it is plus or -5, above that, you have to do something about it. It is possible that your situation may have changed, your risk profile may have changed, but it will not change significantly within a short period of time. If it has been meant to, like, for example, you receive a really good bonus or something else, so it may change, your risk profile may change. You may decide, okay, I want to take a little bit higher risk, or I want to change my strategic allocation, but that would become the tactical kind of allocation if you want to take certain benefit from it. But I agree with Mrin and you as well that rebalancing has to be happen once a year at least, or at least at a major life event changes. Again, 5%, I think it's a 5% range, plus and minus 5% is a really, I think, decent range to track and do the rebalancing.
And I would think that it's a mathematical formula that won't lead you wrong, because invariably a 5 percentage point or more deviation would entail that either the equity markets have outperformed or they've underperformed. And in that situation, you're either buying low or you're selling high. Let's talk about the third point, Mrin, that you've mentioned, and it's related to the earlier point, but I think there's a nuance that you want to talk about here, which is to do with diversification, and I think that's important to talk about within the equity portfolio as well, because I think a lot of people have perhaps allocated too far into small caps, and you're seeing a little bit of a crack in certain pockets today.
Absolutely. A lot of times these days I see that, there's this trend to follow what has done well in the last 6 months. And what that's really leading to is concentration risk, right? So there's a concentration in specific stocks and specific sectors. That's, of course, leading to a lot of overlap. And I think one of the things that's very important to remember is that every 6 months, the best performing asset class or the subcategory is going to change. And hence, it's very important to be well diversified, not only between asset classes, so that means between debt, equity, and gold, between market caps, which is large cap, mid cap, small cap, and also within fund houses. Alex, many times I come across portfolios where, for example, people have diversified between large, mid, and small cap, but they have done it all with the same fund. And the idea of diversifying, within fund houses is also because you get a different style of management, different set of stocks that the fund house has high conviction on. So I think, diversification is not just putting debt, equity, and gold. It is much more than that. And again, even with people doing passive funds, I have seen people having 3 Nifty 50 funds, which is really not going to give you diversification. Of course, there's this whole big trend towards factor funds at this point in time. So again, is that factor fund really giving you the diversification? For example, if you're choosing a NSE 500 Momentum 50 fund, for example, is it really giving you diversification? Or, for example, I know that I did this last time in your show, where we were talking about NSE 500 and how 73% of concentration is in large cap stocks. So is it, these are the things that one really needs to go deep into to see that, am I truly diversified in my portfolio?
That's a fair point. Jigar, the next point that you've talked about is risk-adjusted return. And I guess this is similar to what Mrin was talking about, to say you need to, of course, have a benchmark in terms of how much you're gaining and how much the potential for gain is, but also be aware of the kind of risk that you're taking.
Completely, I think risk management is the most important. People always concentrate on the return maximization, but minimizing risk. Actually, increasing the risk-adjusted return is really critical. It may be, it could be having the same risk, getting a higher return. And if the returns are the same, how can someone can reduce the risk? Because if the market goes down, let's say 25%, it takes 33% of growth to even it out. So that being said, if you can minimize the risk, if you can minimize the drawdown or in the portfolio, that would increase the probability of beating other funds as well. So risk-adjusted return for me is one of very good important criteria when you are evaluating the health of portfolio.
Mrin, you've mentioned this as your fourth point, and is there a way to measure that in your portfolio risk? You both essentially picking the same things. I'm not surprised really, but is there a way to measure risk overall in your portfolio, particularly to do with equity?
So I think, you know what, one of the things that I know it's not very easy to really measure it, other than to really say that, okay, I've got this much exposure to equity, and so that is the amount of risk that my portfolio carries. But I think, something that's very important at this point in time is to actually see whether the risk that is taken is in line with the investment time frame. And today, of course, we're seeing this whole overexposure into small caps. Very often I hear people saying that, in 2-3 years, I can make like this 15-20% sort of a return in small caps. So I think it's really important to check whether where you have invested, is it actually the risk that you've taken, is it actually in line with the recommended time frame?
Jigar, just to follow up on the risk bit, a lot is said, and I know that you as in the advisor community, look at various ratios. For the DIY investor though, and looking at various platforms available where you can read these ratios, do you pay attention to that? Is that something that you would recommend?
Yeah, of course. I think there are a couple of ratios that there is a Sharpe ratios, and there is also a Sortino ratio. There's a drawdown ratio. There are 2-3 ratios. If investor can just take a look at it, that helps them to better understand the risk.
Fair point. All right. So that's the point that I was trying to get across. Of course, we will do a separate show at a later date to talk about each of these ratios. We have in the past, but we will do it again. The last 2 points, Jigar, that you mentioned are more or less the same, so I'm going to ask you to club them. You've talked about absolute and rolling return compared with the category average as well as to the benchmark return. Obviously, these are going to be very important to take, but would this fit in your once in a year kind of a time frame? And I think this is a very important point to make, because last week, at the end of the week, we did a show where we talked about the top 10 mutual fund houses by assets under management in equity. And we spoke about the top 3 performers in each of those mutual fund houses. And what we essentially found is that there are similarities that can be drawn, but for some fund houses, and I will name Axis Mutual Fund here, their top performers were the large and mid cap, whereas most others saw either sectoral or thematic or a mid cap or a small cap fund. And what was pointed out at the time was that they are now probably going to see green shoots in the funds that they operate in because of the way that they manage their funds. Is this what you want to talk about?
Here what happens is people, when they invest, they only invest based on how much return they have generated, any fund has generated. So what happens is, yes, because of the higher ranking, people and investor will go, okay, because this fund has performed well, let's invest in that. But it's not only the absolute return, you also have to look at the rolling return as well. And whether is it a one kind of event, or is it consistently this fund is beating the benchmark or beating the category average, that is also needs to be looked out. So that's why I have those two comparing with the benchmark and comparing with the category average, both on absolute basis as well as rolling return basis is important.
And you will also see a very different picture being presented. What we interestingly found is that 14 out of 30 of the schemes of those 10 mutual fund houses were sectoral or thematic, and that's likely because of outperformance over the last 1.5 years of a particular theme, whereas a rolling return will give you a perspective of more, a more regular outperformance or a more regular performance. Let's talk about your last point, Mrin, and you've talked about cost, and which is an important point to make, cost and liquidity. Of course, because that is deductible from the kind of returns that you would normally get, and people don't pay too much attention to this.
Yeah, so actually, you know what? I wanted to talk about two things here. One, where liquidity is concerned more with respect to debt funds. So again, if you're going for funds with riskier profiles, the liquidity could be an issue. So I think it's a small aspect, but I think one should consider it. Costs I wanted to talk about from two aspects. One was just from a pure index fund aspect where there is this whole big move towards passive investing. Many a times investors are only looking at the expense ratio while they take the decision. They're not actually considering tracking error, which is what needs to be considered, because that kind of tells you how optimally the fund is able to replicate the index, right? And of course, that's a better measure as far as index funds are concerned. So the reason I had this was to really point this factor that sometimes it's not the expense ratio, but for index funds, you do need to look at the tracking error. The second thing actually I wanted to talk about was actually opportunity cost. So again, I do see that I do get a lot of questions saying, should I just go direct because the regular plan is more expensive? And I always say this, that the difference between the best and the worst performing fund in a year is going to be at least 6 to 7%, So when you're trying to save that 1% cost, right, you need to also choose the fund right, because if you choose a wrong fund, you're going to end up with a 6% lower return. So really wanted investors to also think about these aspects, from this perspective that, have you thought of expense ratio and chosen and gone for a direct plan, but, maybe chosen a sector or a thematic fund, which may not work out for you in the long run. So I think these are also factors to look at.
Absolutely. And points well made, both of you. I think today of all days, I'm not talking about a major drawdown in the equity markets. After all, if you look maybe a couple of weeks down the line, if you look in the rearview mirror, this is not going to be a very large event to talk about. But that's certainly something to bear in mind when you look at the health of your mutual fund portfolio. Let's talk about the second topic which I've lined up today, and it's an interesting one. You've seen a lot of people move overseas and change their tag from Indian domicile to NRI. There are changes in the way that you would need to manage your mutual fund holdings and other investments. So I decided let's talk about this today. Jigar, let's first talk about the implication from the tax perspective of shifting overseas. What happens from that perspective?
For tax perspective, I don't see a lot of changes. The only change would be that there will be a TDS deducted on the capital gain. So for tax perspective, it is not that much difference between a resident and an NRI.
Okay.
More important is the FEMA, because when you invest in mutual funds, Foreign Exchange Management Act, FEMA comes into picture, because it will be, because FEMA regulates and covers everything that NRI does in India. So any investments that a resident had, now after becoming an NRI, he has to follow and comply with FEMA rules. So I think the first choice and first thing he needs to do is doing the KYC. And he needs to change the status from resident to non-resident under KYC. Now, the problem is that people follow definition of Income Tax Act and use and apply that for investment, which is governed by FEMA. So technically, what investors should do is first, they need to understand the definition of resident and non-resident under FEMA. As per FEMA, if someone leaves India for a job, immediately from that day itself, he becomes a non-resident. So when he does KYC, he has to put non-resident. He does not have to wait 182 days to become or declare himself as a non-resident. So this is the basic and most important thing. Most important thing is understand the FEMA, update the KYC, and once the KYC is done, you need to update the bank account, because again, FEMA doesn't allow non-resident to have a resident account. So they have to change the bank account from resident to NRO.
Yeah.
And
In fact,
update
that's the first point that Mrin mentions, change the existing savings bank to NRO. Mrin, any other things that you want to add in terms of specific geographies?
Well, of course, as Jigar mentioned, you have to update the KYC once you become the NRI, and you have to change your bank accounts to NRO, the savings bank account that you're having in India. And then, you also have to visit each of the fund houses individually and give them a change in tax status, bank details as well. And you'll also have to give the FATCA declaration as well. Now, I just want to mention one more thing. Specifically, if you have moved to US or Canada, most of the fund houses do not allow you to invest online, and you need to be physically present in India when you want to do the investment or when you want to redeem the investment. And there's also a declaration that you have to additionally provide every time you invest, or anytime that you want any transaction that you do. There's an additional declaration that you'll have to provide to the fund house. So this is one very important point for the US and Canada residents to remember. And this is, because of the whole FATCA rules that are there, that this sort of a thing is there.
I was speaking to somebody just yesterday, incidentally, and they said that their sister moved overseas. And their father, what they did was they used a gift deed to transfer their shares and mutual fund holdings. Is that common practice, Jigar? Is that something that is done, and why is it done?
Usually people, because once someone becomes a resident of USA, they have to pay tax on their global income. So whatever the income they earn in India, they have to report there. So there are certain forms, the F bar is there, form 8938, and then other different declaration has to be done. If your portfolio is not that much, or if you don't want to pay tax in USA for the income in India, this is one of the way that they transfer all the assets to their relatives, usually the parents or the kids, and then investment can continue with their name, and they don't have to report the Indian assets and income in their US tax return. So that is usually the reason for that.
Okay, fair point. If you are moving Mrin overseas for a temporary on a temporary basis, I would think that you would still want to invest in the India growth story, because it is ultimately the fastest growing economy, and it is a market that is in a romping bull run. And so from that perspective, would you advise NRIs to definitely invest in the Indian equity market, and what should they bear in mind?
Oh, absolutely. They should invest into the Indian equity markets and keep their investments as it is. I think the main things that they'll have to keep in mind is the whole repatriability of the funds, considering that these are in NRO. But, I think that's the main thing. Of course, you have to keep in mind the currency fluctuations and all that. But I think, from a long-term perspective, it's a great story to invest in, and certainly hold on to your investments.
Okay. All right. I do say that this show is also geared towards answering your questions specifically, and viewers, I would encourage you, in fact, we can pull up that number on the screen right now. That is where you can send your question to us. If you've got a question for us, remember to tell us your name, your age, and what the goal is. Why do you need the money for? The first question we're taking is from Sundar. Sundar is 61 years old and is asking for a suitable allocation for lump sum investment of 50 lakh rupees. The goal is wealth creation over a period of 7 to 10 years. Sundar points out that they are a first-time investor. Now, it is a bit of a tricky situation. I'm not sure, Jigar, what the other holding is apart from this amount. And I'm guessing that this is to fund later retirement and to generate a certain amount of capital gains in order to facilitate that. So with that caveat, what would you suggest?
I would recommend the hybrid funds, especially the balance advantage kind of a category, or the multi-asset fund, because it will have not only equity, but equity, debt, as well as the gold and other assets as well. So personally, my recommendation would be to find funds in a hybrid category. My recommendation within hybrid also, either multi-asset fund or a balanced advantage, but he can also go with aggressive hybrid or conservative hybrid in other hybrid funds as well.
Any schemes that stand out to you? Not a recommendation, but any ones that you're looking at closely?
Usually, I think in hybrid funds, I like the ICICI balanced advantage, and then in multi-asset, like HDFC multi-asset is also good. So the other funds as well, nice game.
Mrin, you want to weigh in on this?
So actually, I agree with him. I think, given his age and the fact that it's a first-time investor into mutual funds, I would actually say that just stick to the balanced advantage funds. And of course, ICICI is a great fund to get into. But just stick with that because that's going to do your regular rebalancing for you. And that's a good way to really start if you're starting at this age.
We have time for a quick question. Gunasekharan, who's 72 years old, is investing or wants to invest 15 lakh rupees through a one-time investment. So it's a lump sum for their grandchildren. The time span is 5 to 10 years. How should they allocate? Mrin, it's an interesting question. It's a beautiful thought.
Yeah, so, just speaking from the allocation perspective and not from the operational perspective, but they could look at, again, balanced advantage fund if the period is 5 to 7 years. And for periods above 7 years, like let's say 7 to 10-year period, they could look at equity funds. Again, if you don't know what fund to get into, a simple Nifty 50 index fund is a good way to invest.
Yeah, absolutely. And that brings us to the end of this edition of the Mutual Fund Show. It's been a pleasure bringing it to you. Do stay tuned. Lots more coming up on NDTV Profit.